With me today is Helen Currie, PhD. She is the chief economist at ConocoPhillips. She was also a 2018 oil and gas investor, Women in Energy honoree. We're very thankful to have you with us today, Helen. You know, the last few months, it goes without saying how uncertain it's been, but we'd like to talk to you about our path forward, or the path forward. How much oil demand was lost globally during the past few months, Helen?
Yeah, thanks, Jessica. It's great to be here. We appreciate the opportunity to talk with you. The COVID-19 demand shock is truly unprecedented, but at the same time, the downturn on the demand side that we're dealing with was created by policymakers with the intention of trying to contain this public health situation. And it looks like it's working well. We're not out of the woods yet, of course, but it's looked like things have moved in the right direction. So in thinking about oil markets, there were estimates for April demand to be off just huge numbers, as much as even 30 million barrels a day for April, and maybe then coming back to being down 20 in May. Our own view internally wasn't quite that steep, but there was always that possibility that the market was really going to go to some very low points. Some good news is that the actual data is starting to show that we might not have dipped that low. It was a very big dip, but the preliminary data that's coming out is showing that April may have dropped more like 20 million barrels a day from the prior year, and in May something lower than that. Either way, it's been a very difficult period, but fortunately, we're now at a point where the markets are starting to move in a positive direction for demand.
And speaking of that, moving in a positive direction for demand, do you see global demand returning to 100 million barrels per day? If so, if you look into your crystal ball, can you tell by when possibly?
We're thinking it's going to take some time to regain that 100 million barrel a day mark. Mm-hmm. There's still a lot of uncertainty in the coming months around the spread of COVID and the pace at which economies are going to reopen. There's still the possibility of a second wave of outbreaks, and that closures could return. We just don't know that. But what we're thinking is that allowing for some amount of second wave, that demand will generally trend in a positive direction, but we probably won't get back to that 100 million barrel a day mark until maybe the third quarter of 2021 on a quarterly basis. And then when we think about the world demand on an annualized basis, it'll probably be more like 2022 or maybe 2023 before we achieve that again on an annual basis. But we do think we're moving in that direction.
I think you mentioned, of course, some of the key indicators you may be monitoring to try to help you form that view. But is there anything else that you are looking at to help form that view on the demand recovery?
There's a whole host of things that we try to follow. And the key thing that we've been focused on recently is leading indicators, so that we can try to get an advance notice of, is the demand recovery solid, and is it going to stick, or are we going to see more of a flattening of demand through the summer months? So there are some of the specific things, for example, that we're looking at are around mobility, people getting out and moving, shopping, driving data, VMT, passenger travel through airports and flights and so forth. So there's a lot of data out there, fortunately, that we and other folks can look at to try to get an idea of how solid the consumer response is to the reopenings.
And for ConocoPhillips as a U.S. operator, there's a unique perspective into the supply picture. What is your view on the outlook for U.S. production? Do you see another wave of industry consolidation coming?
This cycle is going to be another round of the industry probably doing what we didn't think we could do. And what I mean by that is that as efficient as we were going into this down cycle, I think we're going to see that we again find ways to continue to be more efficient. We're still seeing productivity improvements occur. They are incremental, not as large and significant as the industry saw 4 or 5 years ago, but they're still there. And we do see the service sector is getting hit hard in this down cycle. But on the E&P side, that contributes to costs falling as well. So that translates into some incrementally better or lower break-even costs. And I think that will help the sector along the way to recovery. And what we're likely to also see will be some consolidation as we go. You can think of that maybe as another way in which the sector as a whole becomes more efficient as we consolidate assets and kind of spread across a smaller number of companies those fixed and overhead costs in the sector. That puts us in a better position that's more efficient overall. And of course, part of that's also going to be operators really focusing on return on capital, and capital discipline is really about creating value for investors as we go through this. But to also touch on part of your question around the U.S. production itself and our view on what those volumes are going to be in the marketplace, we're thinking that production, as you know, production is already on a downward trajectory today. There have been a lot of voluntary curtailments in the industry in the lower 48 in Canada. ConocoPhillips is part of that. And we're thinking that total U.S. production is probably going to start to plateau in the next few weeks and maybe turn back upwards as we get into the third quarter. That's really going to depend on the rate at which companies start to bring back those volumes that are curtailed. The futures market is currently fairly supportive of returning some of those volumes when you look at the NYMEX and Brent. So we're expecting some of that to come back, but all in all, we're thinking that by the end of the year, we'll probably be exiting 2020 somewhere around 2 million barrels a day below the 2019 exit rate. But to take that a little bit further and think about year 2021, we're thinking that the market will be more supportive of U.S. production in 2021. So by the time we get to the later part of next year, we're thinking that U.S. production could likely be on an upward trajectory again by that point in time.
That is good to hear. If we can look internationally now, Helen, what do you see happening with OPEC or OPEC Plus as the year progresses? What about other actors in the Middle East?
Yeah, the OPEC has had a lot of influence on the current market structure. The recent cuts, which just this past weekend they did extend the very deep cuts through the month of July. That's putting a pretty solid floor under the market. And when we think about the fundamental supply and demand balance, those OPEC plus cuts, because Russia is a big part of that, of course, and a handful of other countries, that's shifting the market balances over the second half of this year to be much more constructive for prices. So we're thinking we could start to see on a global basis, we could start to see inventory drawdowns by the third and fourth quarters of this year. I think the challenge for the OPEC plus group is going to be to maintain discipline among themselves and among the participants in that agreement, because as prices start to rise over the second half of this year, the temptation's always there for the participants in that agreement to increase their production as they go.
What about non-OPEC countries representing a significant share of global oil production? We know, how do you see their prospects for growth going forward? Will there be new or different opportunities there?
We think there will. There's a lot of really good quality projects and production opportunities in the whole non-OPEC space. The U.S. is certainly one part of that. But when we look at many other non-OPEC countries, from Canada to Brazil, Norway, all around the world, there's a lot of really solid and competitive projects that we think will be brought online. It's really, that gets back to then really kind of a matter of timing and what is from a capital allocation standpoint and generating returns to stakeholders, what's the best time to bring those projects online. But we think the resource is there, and it's competitive. The timing then becomes the issue for those volumes coming back to the market.
And expanding on timing, I guess, as someone so ingrained in the industry, can you give us your thoughts about, as we end 2020, looking forward to 2021, what is the path forward from here?
We think that the sector has a very positive story to tell, and we have a bright future ahead of us. We think about our future in the context of the world has a growing economy, and the population is growing, and that translates into the need for a greater amount of affordable and reliable energy. And we've seen that oil and natural gas really feel that need to a large extent. So by and large, we think that oil and natural gas demand will grow as we go forward. Kind of thinking about that same question from a supply perspective, I mentioned a moment ago, we see a lot of opportunities for competitive projects across the non-OPEC space. Within the U.S., we absolutely think U.S. tight oil will persevere. It will come back. It will come back probably on a slower or lower growth trajectory than we saw in the second half of this past decade. But we still think that the resources there, the efficiency and productivity improvements are going to continue to occur, and that's going to keep that resource base very competitive.
We certainly hope so, and do understand your expertise, and we appreciate you sharing it with us, Helen. Thank you very much for your work and helping us look forward to as we move on through this.
Thank you.
You're very welcome.
For more Hart Energy videos, follow our social media channels.